Welcome back to lesson 2 on how to invest in the Nairobi Stock Exchange. So in this lesson, I'll be covering the important NSE ratios in my mind and the things that I thought that 6 years ago when I was starting this should have been, said up front. So I've prepared a dummy income statement and balance sheet in just a few numbers to make it simplified as possible. But the first thing to say there is subscribe to the YouTube channel. This will allow you, and click on the bell icon. It will allow you to get notified when I have new live streams or when I've uploaded new content. That said, let's start. So one of the most important things, and I said in the previous lesson, that you can earn money in two ways. Number one, it's capital gains, or number two, it's dividends. I find people tend to chase the capital gains, but for me, I always want to view them as the icing on the cake. And the reason for this is, if you've gone through my compounding lesson, you find that what is important in growing your wealth is actually the impact of cash flows. So as long as an investment is bringing money every month or every quarter or every year, then it's compounding. Um, and the thing with capital gains is or capital losses is they are not cash flows. So you'll only make money when you sell. So one of the things that I find when you're investing in the Nairobi Stock Exchange or in any securities exchange for that matter is focus on the dividends, because then you can wait out over time for the capital gains to come, but during that time you're also earning money. So that's why I started with the dividend yield. So the dividend yield is calculated by, as you can see here, it's you divide the price you bought the share and the dividend declared. So this is important because the price you buy the share actually determines the dividend yield that you'll earn going forward. So for example, somebody who bought this at 10 bob has a dividend yield of 20. So if you want to calculate how much a stock that you own is earning you, just take the dividend that they declare divided by the price you bought it at. So normally what you'll see in the newspapers is the price, the current price. So if the current price right now, for example, is 20, the newspapers will show, or let's use 50. The newspaper will show a dividend yield of 4%, but somebody who got into this share at 20 bob is enjoying a dividend yield of 10%. So that is the importance of, buying at the right price. Okay, so that's the first one. It's the dividend that the company has declared over the price that you bought it at. So the important thing about the income statement is you need to pay attention to companies that, number one, are making money, or number two, have enough cash reserves to pay out dividends, because if those two are missing, then the company won't declare dividends. Okay, so but we'll get into the nitty-gritties of this in the next lessons. For now, it's just to cover the basic ratios. The other ratio that you want to understand is the earnings per share. So you'll always find that companies have a number of shares that are out there. So in my hypothetical company, you have 1,000 shares, and the company had an income of 10,000, expenses of 500, which is a very cost efficient company. You will find this in real life. Profit before tax, or well, you can find it with some of the bigger companies. Profit before tax then will be your expenses minus, sorry, your income minus your expenses, which gives you your profit before tax, and then tax at 30% to get your profit after tax. This number is very important because it determines your um, earnings per share. So your earnings per share is what is left out after you've paid the piper, the government in this case, to go to shareholders. So in this case, it's 6.65, which is basically the profit that you made over the number of shares. So that's how you calculate the earnings per share. This is important because the company can decide to give out the whole 6.65 as a dividend, okay, or they can decide to give a portion of it, and that's where another ratio that I had actually not included here becomes very important: dividend payout. So the dividend payout is how much of this earnings per share does the company pay out? So this company pays out, it pays out about 30%, which is a very good dividend payout. Okay, so yeah, but if somebody is paying 100%, it means they would have paid out the whole 6.65. Okay, so that's important. The other thing you need to know is obviously your price per share. This is the price that you bought the share for. The next thing that I find very important when it comes to analyzing stocks is the price to earnings ratio, or PE ratio. So this is exactly the way you read it out, price to earnings. So if you follow this formula here, it talks about your earnings per share divided by the price per share. And what this does, it tells you for every 1 shilling you spend buying this share, how much are you getting back in terms of earnings. So this is a very nice company because, well, my hypothetical company is very nice because for every 1 share you invest in this company, you are earning 3 shillings in return. So that means you're almost earning 33% return from your investment. And I actually had my notes here from Warren Buffett, because reading about Warren Buffett when he talked about uh, the PE ratio. So for every, in this case, 3 shillings, three three, which is the PE ratio that I spend buying this share, I expect 1 shilling in earnings. That shilling can be paid either in dividends, or it can increase retained earnings, which increases the book value. So I'll pause there to explain what is book value. Book value is another key metric when I actually buy any share. So it means how much is this share? If we were to close this company today, how much would the shareholders get back? And you get your book value by getting your equity number. Your equity number is how much the owners of this company own, and equity is how much you contribute at the beginning of the investment, or the company in this case, and then it grows over time with either profits or losses made during the years. So in this hypothetical company, we have equity of 41,000, and an easy way of calculating the equity number, so it's also to take all your property, your cash, and deduct all your liabilities. You'd get to the 41,000. Okay, so but then again, it's 41,000 divided by the number of shares, which is 1,000. So it means this share is actually discounted because it's trading at 20 bob, yet the book value is 41. So, and this creates another concept again from uh, the intelligent investor, and Warren Buffett loves this a lot, which is called the margin of safety. So it means if you buy this share for 41,000, you actually have a margin of safety of 205%. That means that by the time you're buying this share for 20 bob, even if it was to close down then, you'd lock in gains of 205% because the share, the book value of that company after you paid your creditors, etc., is 41. So this is very important, and it's a concept that once you realize its power, it will help you very much in terms of selecting companies. Because what happens in the stock market is you have your two emotions, so fear and greed. So let's say something happened in this company and people have panicked and they've started selling this share without sitting down to calculate the book value. So maybe that's why you are able to buy this share for 20 bob, whereas the true value is 41. So it means just by buying at the right price, you can actually lock in your future gains, because all this person needs to do is wait out until this 41 is realized. And the beauty of what I was saying in the beginning with dividends is, if this thing is earning a dividend yield of 10%, then he can wait it out while earning 10% every year. Now that's a nice proposition. Okay, so that's P ratio explained, that's book value explained. Price to book value is just another way of measuring, um, comparing the book value to the price, just to know if you're getting a deal. So the lower the better, for example. So what it means is, and this you can divide, you can see the formula here. It says It's the price of 20 divided by 41 to get 0.5. So that means for every one share that you buy, and I can even show you the logic here. Okay, so for every 0.5 cents that I spend buying this share, expect 1 shilling in equity. That's brilliant, because then it means you're buying this share for 50% of what it's worth. So very important concepts here. Okay, and then as I finish, these were some of the notes I took when I was a rookie, so I wanted to share them with you. So here I was saying that it makes sense to look at financial data at a per share level. That way you don't get seduced by big numbers and you actually see through how your one share is working for you. The beauty of looking at numbers these ways, I also found that I used to make the mistake of thinking a share that is worth 300 is expensive. But once you go through the mechanics and look at the numbers per share, you can actually find out that a share that is worth 1 shilling at the NSE is expensive than a share that is 100. And the only way to do that is to break it down per share. What is the earning per share? What is the P ratio? What is the book value? What is the price to book value ratio? So that's a very important concept that really helped me breaking it down per share and trying to assess whether a number makes sense, not just from a price perspective. You know, people tend to start with shares that are below 10 bob and ignore um, brilliant opportunities for shares that are trading at 50 and above. Okay, so and then I did mention about these P ratio, and I'll get into the insights later. And then the other thing is the price to book value. And then I just wanted to skip all this and tell you about what Warren Buffett recommends when investing in a company. So the first thing, it needs to be a stable company. So you need to invest in a company that is making consistent profits, is well managed, etc, etc. So your earnings and your equities, if they are growing, it means your book value is growing, which means then your chances of realizing the book value and making money increases. You also need to understand that the company that you're investing in, how do they make money? Who are their competitors? What is their competitive advantage in that market, and so on and so forth. You know, you also need to look at companies that have long-term prospects, because as an owner of the company, you should be comfortable to answer the question, can I own this share for the next 100 years without worrying about anything? And that can only be for companies that have long-term prospects. You also need to look at the management and the quality of the management, and this is something that I used to ignore, but I take it very seriously these days, because management can actually come in and make a company that has a book value of 41 have a book value of 1 cent because of just mismanaging money. So, and this we've seen actually a lot with companies that are owned with the government, companies that have a lot of potential, but because of mismanagement, you find that they keep on eroding the shareholders' value. And then finally, you need to look for companies that are undervalued, and that is basically what I was talking through in this video, that you want to be buying a shilling for 50 cents. You know, you want to be buying companies that are worth 41 at 20 bob, not buying them at 100, and you can see what happens. Your dividend yield goes down, your P ratio goes up. So the bigger the PE ratio, the more expensive the share. You can see your return on investment, and your price to book value also goes down, and your margin of safety is 41%. That means that if that company was to close down today, you'd get 41% of your investment, whereas this other person would have increased the investment by 200%. Hopefully this is helpful. What I'm going to do is to premiere this video so that people who want to ask questions can chat with me live. So next time I'll sort out this issue on the live streaming so that you can be able to ask the questions as we go through the workings. Cool. So thank you very much for your time. Hopefully you've learned something. Remember to subscribe, remember to share the video so that you can educate as many people as possible. And if you like what I'm doing, leave a like and a comment. Bye bye.